In this week's update, the odds favour the selling is done. And where to from here? And what's happening in lithium? My name's Garry Davis. As always, this is general advice only. And please remember to like and subscribe to the video. Okay, let's just start with some market perspective. This is going to be a bit of a shorter video. I'm not feeling terribly well at the moment, so I haven't been able to put the time into this that I normally do. But certainly we'll be covering the really important points because it's a pretty pivotal time just at the moment. Now, just looking at China, it's always really, really hard to know what's really happening in China. The only sources we really have are Western media sources. So, it's difficult to really have a feel for what's happening there. But when you look at an issue like, let's say, youth unemployment, which was last officially reported at somewhere around 20% and rising. Obviously, the Chinese government doesn't like the data, and so they've just stopped reporting it. So that's probably a really, really serious problem in the making, if it's not already. And then that comes, of course, on top of a property construction sector that's in big trouble. We've now seen Evergrande file for bankruptcy protection in America. And another major developer, Country Garden, is looks like it's missing their bond repayments. So lots of nasty things happening in the Chinese economy. And when you couple that with weak consumer spending, it's not a good outlook for China at all, and therefore can't be really positive for stock markets around the world over the longer term. Now, switching to America, strong retail sales data really fired up the bond market, went up above 4.3 on the 10-year yield. And that, of course, also fed into the US dollar as well, which edged up a little bit more. So that puts further rate rises. I think the market had come to terms with the fact that there might have been one more rate rise. That puts even more rate rises back on the table, and there'd been a premium in equities built in, particularly the rate-sensitive equities, had been built in on the expectation that there would only be one more rate rise at most, and that we'd probably see some rate cuts in 2024. Well, the events of the last week or two have turned that on its head, and that's contributed to the correction. But as I said, I've been saying for several weeks, as members know, the correction was due. August, September, typically weaker part of the year when the market is been really strong going into that time of year, you often get a correction. And then with all the issues, both in America and in China, it was almost a slam dunk that we were going to get a correction. And I talked about this in the Sunday videos on July 23 and also on August 6, looking at both the logical fundamental signals and also the technical signals. The logic came first. The market held up longer than what the logic would dictate. But then eventually, the technicals took over, and we'll have a look at that chart in just a minute. So for me, it's always a matter of, I learned many, many years ago, more than a decade ago, that the best way to survive and prosper in the stock market is not to try and outthink it, not to try and guess what's going to happen, not to try and be a smarty and predict things. It's just pretty straightforward. You just observe what is happening with overweighting the technical signals more than what logic would dictate. And then be prepared to act on it. Act on what you see and not what you think. And that is the route to success that I found many, many years ago. So if we look at the market technical signals, particularly in the options market, the options market has moved very, very quickly from being at real excess, where it was certainly begging for a correction, and we've moved very quickly to the other end of the spectrum now, where everyone has turned so bearish, and the put to call ratio is reflecting that bearishness, and it's almost a capitulation situation in the last couple of days. And when you see that sort of capitulation, it's likely that you're going to get a reversal. Now, this is clouded a little bit because it was options expiry, third week of the month. So, you can never feel really confident that the price signals you're seeing are not just transitory for a day or two. And there were plenty of individual stock reversals, but I'm really in two minds at the moment, not taking a particularly strong position because it just, we're only third week of August. We've still got another 5 or 6 weeks before we get out of this August-September period. So I'm a little loath to sort of jump on the options market capitulation and call the lows. It may well be, and I'm certainly open-minded to that, but I'm not going to throw the kitchen sink at it, that's for sure. So I think a bit of caution warranted, but we're in a much better position now from a contrarian reversal than we were a couple of weeks ago. That's the message. And that's the message that members have been getting constantly every day through the Insiders Club. Always up to date on what I'm seeing and what I'm thinking and where our targets are. So it's all about being prepared. You got to know what to look for in terms of the signals, and there's many different signals, both fundamental and technical, that I look for. But most importantly, you got to be open-minded to respond. Not get locked into a certain view of how things should be. Have your target list primed and ready to go. As I said, I think last week, this correction is not. I didn't expect it to be a significant problem. I expected it to create an opportunity. And I identified a couple of support levels, one of which we've reached, as you'll see in a minute. Those who want to be grandstanders and big note themselves, or those that feel that they need to be right, do not survive in the market, and particularly in markets like this. So if I can offer you any advice at all, is get rid of that desire that you might have to be right, because the market will always be right at the end of the day. Turning now to American stocks, the S&P fell 2.1% across the week. It felt worse than that, to be honest, but that was the scoreboard once we got a bit of a rebound on Friday. We're now down 5.4% from the peak, so it's still relatively mild, and we hit the first level of pretty obvious support, or very close to it, and had a good day Friday. But I'm still a little wary because of the seasonality and the fact that it was options expiry. So I'll need to see a bit more evidence next week that we're going to get follow through to the upside. And I want to see some volume behind that as well. Now, the VIX spiked to a 3-month high. So again, we've moved to a position now. It's by no means really high. High is above 30. But we're certainly have moved to a position where it's taken a bit of excess enthusiasm out of the market, which is what you want to see. If you want to buy, you don't want to be buying into an enthusiastic market. The US dollar index moved up a bit, again, 103.38. The 10-year yield got up over 4.3, but closed at 4.25. The VIX up to 17.3, and we'll take a look at that in a minute. And the 10-year, 2-year spread is still sitting around the same level. Just under 0.7%. So let's take a look at the VIX first of all. So this is the VIX over the last 6 months, and you can see that we've got a ceiling here around 20. So we dropped down under 20 in March of this year, and we've been under that level the whole time. We spiked up in May. And again, late May, so early May, late May, and we've now worked our way back not too far from that level again. So that's a much better position to be launching a rally from. Not that I'm necessarily, really enthusiastic about such a rally, but I think there's a very distinct possibility that we've now seen the lows. That's the message, I guess. Okay, let's take a look at some charts. So this is the S&P. This is where we were last Sunday on this candle here. So we were just above this support level. we broke through that support level and came down almost to the next pretty obvious level, which I said was another 3.2% down. And I did earmark another level, which was 6.7% down from here, not from here, but from there. So, and that level corresponded to these peaks in August of last year, February of this year, and also the first major level of Fibonacci retracement of the whole move from October to the recent peak. So, these are technical levels that just give you a bit of a guide. So that's where we sit with the S&P. Possible we could come down to here, and really the proof will be in the first 2 or 3 days of next week in America. We want to see some upside, and we want to see some upside with volume in some of the market leaders. Now let's have a look at individually what's happening. This is the Nasdaq versus the S&P. So it's cooling a little bit, but not dramatically. So, and as you'll see from the sector charts, there hasn't been this wholesale move out of rate-sensitive, more aggressive sectors into the, into real defensives. We're seeing it just a little bit, but it's nothing dramatic. So I'm encouraged by that. Semiconductors versus the S&P. We did have a sharp dip during the week, but it's certainly recovered. And so there's been no real technical damage there done either. And if we look at the sectors, so this is going back over the last 3 months. If you go back a few months, energy was at the bottom. Well, it's now worked its way to the top on a quarterly basis. So that's pretty impressive from energy. And then we've got consumer discretionary, which I don't sort of pay much attention to these days because of the dominance of Tesla and Amazon. Communication services, and then technology stocks, and then we get down to finance, materials, healthcare, and staples at the bottom. So that's really interesting. And that tells you a lot about the psychology of the market, the fact that the ultra-defensive staples part of the market is still lagging on a quarterly basis. Let's zoom in a little bit and have a look at the last 2 weeks just to see if anything has changed. And not a lot. Energy had a good week. Healthcare had a reasonable week, rebounded quite nicely the week before. Staples improving a little bit, but it's still closer to the bottom than it is to the top. And consumer discretionary really got smacked around pretty badly. So that's the picture. So there's nothing that is screaming that this is going to develop into something more significant, I guess is the takeaway. Now, turning to the Australian market, so this is over the last quarter, leading the Australian market, energy, technology, so that's our equivalent of US technology, then finance, small caps, material stocks, and healthcare at the bottoms. The ultra defensives of healthcare and staples are not really there's not a scramble to get into those sort of stocks. Let's just have a quick look at the last 2 weeks. Healthcare has managed to stage a bit of a recovery. Energy is up there, so it's pretty clear where the outperformers are over the last quarter and particularly over the last couple of months. So that's the picture in the US and Australian markets. So look at the currencies. So we're getting quite a nice rebound. We're still within this range between 104 and 100, but getting very much towards the top of that range. And that, of course, has pushed, along with commodity price weakness and concerns over China, has pushed the Australian dollar down. We're down to 63.37. Okay. So that's the US market, Aussie market. There's our currency. We were down 2.6% across the week. We're in the middle of earnings season. There's more stocks beating expectations than otherwise, which is a little bit of a surprise. Perhaps expectations had been wound back early. and the energy sector did best in the Australian market. But if you look at the ASX 200, we are still in what has been a 2-year range. This is pretty much the midpoint of that range, somewhere around 7,100, 7,200. And you can see you've got to go all the way back to May of 2021, so more than 2 years now. And then we're also still at the same level as just before COVID hit. So if you've got a broadly diversified portfolio that reflects the index, then you're not getting too much joy out of it, really, other than the dividends. So that's a pretty disappointing picture, I must have to say, and that reinforces why stock picking is not only the best way to gain some real ground in real terms, but it's also the best form of risk management, because there's nothing terribly exciting about that chart. It was a tough week for lithium stocks, but I'll talk about that in a slide or two. Gold was down another $25. We're now down under 1,900, so that's been very, very disappointing. It broke a key support level, and the next stop is another $15 down to 1875, as we'll see. Slightly up because the Australian dollar fell as much as it did, slightly up in Australian dollars, and just a whisker off 3,000. So it's still profitable territory for our Australian miners. But look, right now, the market just doesn't want to know. Gold equities are struggling around the world, not disastrously so, but there's definitely no momentum there. So let's have a quick look at the gold market. So there's gold on a weekly, broke this key support level at around 1913, and this is the next level here at 1875, and then hopefully this doesn't come to pass, but we're down to around the 1808 mark. So that's on the weekly, and you can see it's just dribbling down. Despite the central bank buying, it's just day after day the gold price is going lower. So there's nothing that's really stepping in and pushing it in the counter direction. And if we look at GDXJ, which is basically the global index for mid cap gold stocks, similar sort of picture. It's just day after day, just grinding slowly to the downside. All right, other commodities, copper, pretty steady, around 372. Nickel, similarly, not much change in either of those. And crude oil did get a little bit higher during the week, eased back to 81.40, and it's really consolidating the breakout. And let's take a look at crude oil. So this is crude oil. Let's look over the last, start with 6 months. So here's the last 6 months, just a little hint of a breakout there, and now we're consolidating that breakout, but consolidating high. So that's looking fairly promising, which indeed it should, because the fundamentals around supply and demand for energy are going to continue to look pretty attractive for many years to come because of the underinvestment. All right, now turning to some news in lithium. According to Fast Markets, there's been very little spot activity, so the selling of lithium contracts into the spot market. We've definitely got weaker demand in China at the moment from not only the electric vehicles but also the battery market as well. We've also got stocking or destocking and restocking cycles that are moving around, not necessarily because of supply and demand. They're moving around because of anticipation of other events. So it's you can't just look at the price, and if the price is falling, think that there's something bad happening, that demand has fallen away, because we had a situation in China where there was an expectation that there could be power cuts during the summer months, and so there was a build-up of inventory before that, and that those power cuts didn't happen, And so there was then destocking. So that's got nothing to do with underlying supply and demand. This is still a very young, immature market. And so therefore you don't want to be reacting or overreacting too much to the short-term movements, because these are not reliable price signals in the short term. There's a whole lot of cross currents going on here. So I think with lithium, you really need to be working off a longer term trading or investment plan. So according to Fast Markets, chemical prices in China were down around 8-9%, and the balance in the very short term has shifted to an excess of supply. So, that's the situation where we sit right at the moment. And because of that, we may see prices fall a bit further. So don't expect any great things from lithium equities in the very short term. However, promisingly, spodumene prices did remain firm. But again, look at point 3, and that is it's still a young, immature market. So we've just got to be looking a bit longer term. There's a spot copper chart showing a bit of a tick up, but it wasn't really that significant. The same with nickel. I'm not sure that those charts are actually updated because the prices were slightly down on the week. Now, the long-term outlook still remains positive from my perspective. I've seen nothing in this pullback, this correction, whatever you want to call it, that concerns me about something deeper and more significant. It's always possible, but at the moment, I think we had excess in the market. This is the correction we had to have, and you just got to let it play out. And I think it's an opportunity. It's not a significant problem. But as always, individual stock selection is the most important tool you can have in your toolkit. And if you aren't in a position to do that yourself, then you want to align yourself with someone who can. Portfolio analyst last week, it was a catch-up week, bit of a breather. We have 4 weeks off a year, 48 editions of Portfolio Analyst, and last week was one of those weeks off. But back to the main game in this week coming. There's more information on the website. There's my email address, and I'll be back with you next Sunday. Cheers.